All right, this is Bloomberg News. Thanks for sticking with us this afternoon. I'm Lori Rothman. So let's continue our coverage of the Fed minutes just released at the top of the hour. We've been chatting already with Bloomberg's Rich Yamarone. He's back with us. And now we're joined, well, Michael McKee is also with us. And we are joined, as you can see also in the shot there, by Lakshman Achuthan, the Managing Director of Economic Cycle Research Institute. It is an independent research firm that tracks market trends and provides investment advice for Fortune 500 companies. Guys, I'm very flattered to be surrounded by all of you. Lakshman, since you're the newest arrival here, your opinion on the minutes. And it seems like the Fed is now softening its view on economic expansion, which really doesn't seem to be much of a surprise considering all the other private speak going on of late.
Exactly. If they didn't do that, they would seem quite out of touch, but still they're holding on to some optimism down the road. The growth is going to hold up, and I think that'll probably be tougher and tougher to hang on to as time goes on, as the year progresses, because right around the middle of this year we've started a slowdown in growth, a cyclical slowdown in growth, and that's going to become more and more apparent, I think, in the data, the incoming data.
But your organization puts out an indicator that forecasts economic activity ahead, and I know some people at your group have been concerned that people are overreading it, suggesting a recession ahead when that's not what it says. In 2004, we saw a similar pattern here, where you had strong growth in the spring, particularly in jobs, fell off completely in the summer, and then in the fall just took off. And I'm wondering how your indicator compares and whether we're maybe seeing a repeat.
Yeah, we did. You know, in 03, we had the weekly leading index take off. It was like a moonshot. And that was right. Actually, you know, now that we're talking about the Fed today, that was an interesting time because the Fed in June of 03, that's when they got all scared about deflation and cut rates to 1%. The following quarter, we hit a 20-year high in GDP growth. So they were kind of off in terms of, you know, where things were headed. And that does make me want to look at what the weekly leading index is saying today. It's been going down. It peaked at the end of last year. The growth rate has been going down. It's caught the eye of people who are a little bit more bearish in their attitude, and they're watching that index saying, hey, this proves our point. And given the publicly available data, you know, if you torture the data, it'll say what you want it to say, and it's saying recession in these different models and different iterations. There's about 20 years of history going back before 68 that people don't see, where the index actually did fall more than it has fallen today without there being a recession. That was in the early 50s and the mid 60s. And so there is no holy grail of economic forecasting. You know, as though anyone, I think everybody watching knows that, but still you hope for one. And if you see something that looks good, you say, this is it. You have to look at a lot of indicators. Yes, the slowdown is imminent. It's right here. It's right now. It's happening. A recession is not imminent. We still have to wait and see. It's possible that this ends up as a soft landing because after a spurt in growth, you always have a deceleration.
So you're the king of the double dip camp. Sorry about that, Rich.
No. So I'm pushing back on the idea that a recession is a done deal here, that it's baked in the cake. A slowdown is baked in the cake. So there's a divergence, I'd say, from some of the Fed outlook in that sense. But on the other hand, you know, we're not going all the way and saying it's a new recession. If it comes to that, we will say it. We won't be shy. But it's not today.
You have another indicator.
Yes.
You have the future inflation gauge.
Yes.
So tying in the deflation argument that Lori was talking about a little bit before the break, and Mike had mentioned that we're seeing them ratchet down their inflation forecasts. What does the future inflation gauge say at the ECRI?
Well, for the last few months now, it's been edging back down. During the depths of this recession, it fell to a 51-year low. So that is deflationary territory, okay? But it had a very aggressive recovery coming out of the recession and rose to like a 18 or so month high. So deflation was pushed off the table for now. If we were to go into a new recession, the one truism, I think there's only one truism in economics, which is recessions kill inflation. So if you go into a new recession and you're already really low, you do have deflation risk, probably more than people think. So if we get another recession in 11 or 12 before inflation really starts to build, then you have deflation risk.
Are people so quick to brush off comparisons to Japan in the last decade?
Well, because they want to be optimistic, I guess, is one of the reasons, and because it's tough to say we're just like Japan. We're not. I mean, they made a number of policy errors. They have a lot of different structural issues in their economy.
And of course, the U.S. policymakers are so much smarter.
Well, hopefully you learn, right? I mean, we certainly try to learn from our mistakes. And a critical mistake Japanese policymakers made was in the spring of '97, when the leading indicators, like the weekly leading index or the long leading indicators for Japan, they were tanking, showing a serious recession risk, and they raised sales taxes in the spring. And it took them a year to figure out that they'd entered a recession, where they started to pull off some of the brakes, and there you got deflation.
Locke, it was great to have you on. Richie
right.
Yamarone and my
Thank you.
colleague Michael McKee as well. Guys, you're terrific. Thank you so much for helping us decipher and get into the crux of what's going on with the U.S. economy.